You're listening to Real Investor Radio with Craig Fuhr and Jack Bevere, where we cover advanced real estate investing topics to help you stay ahead of the curve in your real estate investing business. Hey, welcome to Real Investor Radio. It's Craig Fuhr and Jack Bevere coming at you. We're back home. Just visited IMN Scottsdale. For those of you who have never been, it was my first time, Jack. A lot to talk about there.
Yeah, it's a great conference. It's IMN is a conference company. They put on all kinds of business, real estate, finance conferences. And back in 2013, I think, they started putting on a single family rental SFR conference as that industry was just starting to emerge. And they put it on twice a year. You know, back 10 years ago, we talked about this in some of the original episodes of the RIR podcast. It was mostly dominated by institutional investors and folks who were, just really Wall Street, right when they were starting to get into the single family industry and try to figure out, is this an asset class or not? And over the years, the conference has just grown. And they continue to have that particular conference twice a year. They put on a lot of other conferences as well that may be of interest to real estate investors. Their website's worth checking out. I think it's imn.org. And so this SFR conference has really become, I think, the biggest aggregation of folks who are professional real estate investors, lenders, vendors who are serving that SFR industry more broadly. Yeah. So they cover everything from property management and operations to securitizations of rental loans. So it's really covers the gamut.
I have to say, as someone who's been to, as you know, my great share of not conferences, but really, investor related seminars across the United States for the past 10, 12 years. This is I think IMN, for those of you who have not been and who are listening, is a real step above. This is not your, I'm not trying to disparage what real estate investment clubs do or what, the guru class does across the United States, but this is different. This is really, I think you would say, Jack, sort of look, everybody's walking around, first of all, in jackets and suits. And so that alone sort of sets a tone of professionalism. And at least the investors that I spoke with, Jack, I think there are some really fine operators there, folks who are obviously have scaled their operations. And so for those who might be trying to get to that class, I would highly recommend IMN. This was a really top-notch event. They took up 2 full ballrooms to give you an idea of how many people were there. So one floor was just exhibits and booths of all the vendors, and there were a ton. And then an entire ballroom where they would have full sessions, and then a lot of breakout sessions as well, which I know you were a part of, and Fred was a part of too, Jack. So I was hoping that we could talk about just that, like what you guys learned there. What did you think? We're obviously in an interesting economic times, Jack, where there appears to be some folks on the sidelines. Talked to a couple of guys that were like just pencils down. We've consolidated, we've sold off, some non-performing assets. And then we were talking to folks, Jack, it felt like full steam ahead. We're buying 5,000 lots here and we're buying up land. And, there was no indication of any economic, turmoil whatsoever. So what was your take?
Yeah, so the optimism that you tease me about each episode comes, a lot of it comes from listening to those folks in that room, because the people who come to those conferences are still very, very bullish on American real estate for the long term. And so you have folks who, I feel like a lot of the optimism or pessimism that someone expresses has to do with the time frame that they're thinking about, over the course of the next 12 months or over the course of the next 12 or 10 years.
Right.
And, they have these kickoff panels. By the way, we're not associated with IMN in any way. We get no kickback. It's just a conference that we always go to because I always get tremendous value out of it. So, since we get tremendous value out of it, it's something that we wanted to talk to everybody who listens here about. But they kick it off with 3 or 4 keynote panels on just kind of the state of the market. They have a panel of very large lenders that my partner Fred was one of the panelists on, and a lot of economists, and then, as you mentioned, breakout sessions that dig in more operationally or to specific topics, the fix and flip market, property management operations, stuff like that. So anyway, the kind of the larger panels that tend to have more economist types on it, right? Because people are trying to get what's the macro view. The first panel, God, just like there's 5 panelists, they're all super smart folks, like highly vested in making decisions about how to invest capital on a going forward basis. But they're not married to SFR in any way, like necessarily. And so, but the optimism that they all express with respect to American real estate and the undersupply of particularly the affordable segment of the market, there's not a whole lot of folks saying we're undersupplied in luxury, but in the affordable component, that tailwind is something that I think is really driving a tremendous amount of investor interest still on a going forward basis. And I think the conversation ends up being not, is residential real estate a good place to invest or not? Everyone agrees with that. It's, how do you get involved right now with interest rates as high as they are?
That was the guiding
how do you
conversation.
make the numbers work right now? Can you carry negative leverage at all? Can you carry it for a short period of time? Is carrying it for 2 years too long? Those are really the conversations that are being had there. So it's a little bit more nuanced conversation about how to invest in the SFR asset class or in the residential single family asset class.
What was your takeaway with that? With specifically with regards to that, Jack?
Yeah, there are. I think that there is still some concern about low. Obviously, there's concern about low transaction activity, and there's a lot of vendors in the room. There's a lot of lenders in the room, so that issue specifically hurts them more. I think everyone at that conference likes the asset class, is very pleased with how it's performed, even in some stress tested environments, and thinks that relative to other real estate asset classes, that single family is one of the most, if not the most, resilient in a downturn environment. So everyone feels like comfortable that it's a safe place to be. And so the conversation right now, I think, are more focused around shifting your pipeline to, how many rentals are you going to add versus how much are you going to be flipping or trading. The build to rent is still very much a big topic there.
Yes. Yep.
Though that conversation really tends to dig into the issue of negative leverage, right? Where those assets are still trading at a 6 cap, say, just, that's a very broad brush, right? But
Sure.
Those assets are still trading at a 6 cap and the debt's at a 7.5. And those deals are still getting done. I mean, last year, there were no transactions in that category happening. It was like that market came to a standstill. Mm-hmm. But those have started to happen again. Some lenders have gotten creative. If the equity is interested in buying those houses and is comfortable that they're not going to get very much of a current return for a couple years, but that they're going to make it up on the back end through long-term rent growth, because we've got an increasing household formation and we're undersupplied in housing, you can create a 10-year pro forma and look yourself in the eye with a straight face and say, hey, yeah, I'm not going to get paid very well for the first couple years, but we're going to continue to have rent growth over the course of the next 10 years. We're going to have, if you're concerned about inflation, this is the place to be. Yeah. And so we're going to make it up on the back end. And
so is the conversation there, Jack, when you speak of equity, we spoke with Alex, who will appear on an episode. I'm looking forward for everyone to listen to that. Anyway, is the conversation there, if you're forming a fund or if you're going out to equity partners, LP partners, and how do you have that discussion? Hey, we need your money, but you're not going to get any returns for the first few years.
Yeah, I think it's that conversation of, how American housing is a great place to be. The current returns aren't great right now, so we're not going to use very much. I'm sorry, the current returns are fine, but the debt is really expensive right now. But we want to own assets for the long term. And so if you believe in that fundamental pitch and you believe in an operator's ability to find good deals, then you don't want to, you can buy assets right now. Don't use as much leverage right now, right? Like if the leverage is expensive right now, don't use as much of it so that you can continue to produce a dividend to your investors.
So can I
then talk about that long term? Hey, we're undersupplied. We're buying it at at replacement cost. Like if anything is going to go up, we're going to go up, and we're really downside protected in this asset class. And I feel like that's what equity investors are accentuating right now, is that this is a low risk thing over the course of the next 10 years. And it's got an inflation hedge to it. And the combination of those two things, right? Like in an environment right now where people aren't really sure if inflation's going to get, like, it's coming down, but it's not yet fully under control. And if you're concerned about inflation over the long term, residential real estate with a annual mark-to-market lease opportunity like we have in single family, right? We're not signing 10-year leases, we're signing annual leases, so we get to retrade that rent every year, is a really nice profile to invest in right now.
Yeah. So the only fly in the ointment there would be stagnant rents.
Yeah. If we have stagnant rents, but if you're concerned about inflation, then rents, just have historically really gone lockstep with inflation. So they're just a great inflation hedge there. I think the fly in the ointment is a recession. The fly in the ointment is your view on whether we're going to have a recession next year and how bad it's going to be and what that does to rents, what that does to vacancy rates. So there are certainly people who are pencils down until the R word gets off of the Wall Street Journal front page.
Yeah.
But and there's others who are like, hey, yeah, they're going to soft land this, or it's going to be a mild recession, and I'm investing over the 10-year term anyway. So again, it goes back to that, that time frame of your investment horizon. Sure. As to whether you're really concerned, whether you think that potential recession makes it a bad time to buy or not, right? Because you can't go back and if you sit on the sidelines and go play golf for the next year, you can't, put your sticks away and then all of a sudden buy a bunch, put a years of work back in, right? Like you're just not going to have bought those houses. Right. So there is an operational constraint to sitting on the sidelines, right? That you'll own less 10 years from now if you do nothing right now, tomorrow.
I'd say, spoke with a lot of investors. And as I mentioned at the beginning, it was my first time at IMN. We had a Dominion booth there, Dominion financial booth there. So we spoke with a lot of folks, and I thought the general sentiment, as you sort of read the tea leaves while speaking with folks, it was this sort of, hey, we're cautious, man, but we're really taking a hard look at the numbers and how to structure these things. But it was full steam ahead for mostly everyone that we spoke with.
Yeah, there's some like there's some bias to like who shows up to a conference, right? Like the guy who's playing golf is not going to bother showing up to that conference. So everyone's there because they're active. They want to see where the cheapest debt is, right? Like if you need debt right now, you want to be at that conference because every lender in there under the sun is at that place.
Sure is.
And you want to, be able to compare notes with other operators to make sure that you're not the idiot that is missing something that everybody else, understands to be true. And that's what I've always gotten out of the best thing that I've always gotten out of that conference is just talking to people at the bar, right? Like the sessions are good and there's some really sharp people on there. Some sessions are better than others, right? You have some sessions where people are just talking their book and like pitching basically, which is, those are lame. You leave those after the first 10 minutes. But like other sessions have like a lot of high quality content. There's really, the folks on the panel are actually, giving their perspective and you have like a nuanced conversation. And then the bar is like, the bar and the happy hours and the networking hours, like that's where you really get the opportunity to just talk to folks in different segments, get their take on things, get a couple drinks in them and ask them what they're really concerned about, right? Like that's where you get the really interesting content is after a couple vodka sodas. So that's what we always go for is just to see like, hey, which way is the wind blowing? How are people feeling? Like, can I get some honest feedback, right? Like, and not just whatever's being printed in the media or whatever's on people's social media pages, right?
Shout out to Amanda at Stuart Tito for applying us all with great bourbon, by the way.
Yeah, it's great. It's always much appreciated. Always much
Yeah,
appreciated.
exactly. She was awesome. So in those more private conversations, Jack, any takeaways from there? Anything that you were like, oh, wait a minute? Can you think of anything?
Yeah. I think that there are a fair number of operators who have pivoted to more revenue monetization, I'd say, in the current,
Can you explain
in
that?
the near term. Yeah, like they're flipping more, they're wholesaling more, they're shifted their business to more fee income based rather than adding assets and and adding a lot of leverage, right? Like not a ton. I would say it's been a shift a little bit away from building your rental portfolio right now as the cost of debt has gone up.
Mm-hmm.
But I think a confidence in real estate values enough that flipping feels much better. I mean, I had some honest conversations with some operators who were big flippers, crushed it in 2021, right? Like knocked it out of the park in 2021, and then gave a chunk back in 2022. Now, they didn't give it all back. They didn't give anywhere close to all of it back, right? Like if you blend those 2 years together, they had 2 great years. But it was just, it was a grand slam in 2021, and then and then you struck out all 2022, and so they may have actually lost money in 2022, and their things are starting to stabilize, but nothing's easy, and so that's a common story, I think, where people are they're giving back a little bit of profits from that 2022 heyday, and but they want to keep the shop going because they like this business and they're still good at it. It's just the market, knocked their legs out from under them in 2022 and early 2023. But now, as it's gotten harder, it's gotten less competitive.
Yes.
A little bit more seller capitulation. And so the cracks, in the market are starting to happen, and people are starting to see opportunities. Like no one's like, dude, I'm having a blast buying a ton of great deals, but they're starting to find stuff again. And so for the folks who are still in there, still got their ear to the ground, I hear that that's like I've heard that enough that I'm like, yeah, that's not just in and we're seeing that in our backyard too, but that feels like a trend. Like that feels like a thing.
Well, you mentioned on a previous episode how here in Baltimore or Maryland, we should say that when you show up to an auction, there's maybe less people at the auction, and even maybe less people bidding at the auction. And while it's not a seismic shift, you can at least see maybe a small trend forming. And I heard the same thing talking with folks at IMN as well, Jack, that maybe we're starting to see a little capitulation. Maybe we're starting to hit a double instead of all singles all the time. It didn't sound to me like anybody was hitting home runs, Jack, but they are starting to see a small shift in their markets in terms of competition, in terms of transactions, and in terms of abilities to find better deals.
I think that lenders, the other thing my takeaway was that lenders are, they again had a phenomenal 2021, a challenging 2022 because of an increasing interest rate environment. And so it's kind of same story from a profitability point of view. And then 2023, I guess it's kind of a parallel story where there's a lot of folks who are operating at break even or barely, or like a little bit profitable, but not not great. They're keeping the lights on with the hope that enough competition is going to fall out and enough transaction volume is going to start picking up that it's worth it to work here for now 18 months plus without making any money. Making less money. I think that seems to be a little bit of a trend amongst lenders as well. Again, high cost of capital affects them as much as their customers, right? They're not most lenders are lending much of other people's money. They put some of theirs in with a bunch of other people's, and that other people's money has gotten really expensive. So a lot of lenders are running running shops that are highly levered, right? Themselves, that are, they're lending a lot of other people's money. So it's been harder for them to make money on what's left over after the other people take theirs. So I feel like that's been a trend too. And then, man, there was a ton of vendors this time as well. I think that like an uptick, I would say, in the amount of vendors at the conference itself.
What do you make of that?
Yeah, which I took as I would think it's got to be a tough time to be a vendor right now, because like difficult environment, lower transaction volumes. People are they don't take on they don't sign a whole lot of new long-term contracts with vendors and try a bunch of new things when they're trying to also tighten their belt. Now, if you're a vendor who can offer efficiency and decreasing costs, people are certainly going to be interested in that kind of thing. And there's there's a lot of prop tech that
I was going to ask you, I know you walk the floor, and you even, I saw that you had a chance to speak with a few vendors as well. Yeah, talk about the ones that you were particularly moved by, in what they were doing.
Yeah, I think that the conversations with vendors, the ones that were, I think, interesting, or felt like they were like had some momentum, were those that were focused around efficiencies in operations and decreasing costs generally, right? Like trying to get those expenses down for their customers.
Anyone in particular?
No, I mean, there's all kinds of, depending on your particular need and your market. I mean, I think that everyone in that room certainly has customers, so they're fulfilling needs for lots of different folks. But so nothing like was like, oh yeah, everyone was like moving towards this guy. A lot of new vendors and prop tech companies came out of the 2021 timeframe as well, right? Like that was like the heyday for venture capital, Silicon Valley, and private equity, really venture capital, getting into the tech space for real estate. And there was a ton of new companies that were formed during that period of time, and those folks are, we've started to see the weaker of those folks fold and just kind of like fade out into the distance. But it's still a very tough operating environment for that kind of company. And if they have not yet reached profitability, they're running out of time because they're running out of cash, right? So like if you built it on the come and then you were expecting 2021 levels of activity to continue to happen, well, it has been the opposite, right? It has been just like down, down, down in terms of transaction volumes. So that's made it for a very challenging environment for prop hit its pro forma. And if they haven't yet reached profitability, if you go back out into the venture capital market right now and try to raise more money, you're taking a down round. Like the valuation that you're going to get on this next deal, this next round of fundraising is going to be much lower valuation, often much lower valuation than what it was 2 years ago. And so that leads to a whole bunch of problems with like, what do you tell your existing investors? How much money can you raise and at what valuation? Like, is there, at what point do you just throw in the towel and say, hey, we gave it a good run, but I'm going to go work on something else.
So last question with regards to sort of the overall, any surprises, any surprise takeaways, anything that you were like, oh, wow, that's definitely something I wasn't considering before I came here.
I didn't think it would be as well attended as it was.
It was well attended.
Yeah. So because I thought that there would be folks who were just kind of like keep putting their heads down a little bit more. So I think that, and I wonder if the conference was 45 days ago, 60 days ago, would it have been as well attended? Because certainly the drop in mortgage rates over the past 2-3 weeks here have injected a little bit of optimism into the room, I think, than would have been there 30 days ago. And so I feel people are getting a little giddy. They're a little like, wiping their brow and hope, hoping and praying that this is just the start of a continued decline in mortgage rates, which would be good for the entire industry, particularly from a transaction volume point of view. So I guess I attributed to that level of activity and the level of optimism, frankly, to the recent news about mortgage rates. And again, like I said, I wonder if it would have been nearly as optimistic 45 days ago.
Yeah.
Who knows?
Yeah. Well, I know you sat on a panel, and it was regarding sort of the state of DSCR.
Yeah.
So for those of you listening who aren't familiar, which I'd be shocked if there's many, but we write a lot of DSCR loans here at Dominion Jack, and so you've watched that product form and grow over the last few years, and so what was your takeaways there in terms of the state of DSCR loans?
Yeah, we had a really good conversation. I was lucky to be on a great panel of panelists. Gene Clark at Arch West was the moderator. Constructive Capital was on my panel. RCN was on my panel, and another large note buyer was on the panel as well. And they we talked a lot about just kind of like the state of the market right now in terms of where interest rates are, where the securitization market is for DSCR right now, and what that means for borrowers on a going forward point of view, and just kind of everyone try to look into their crystal ball a little bit as to talk about where they thought that the risks and the opportunities were. I think something that we all agreed on was that we've seen a little bit more. I guess, like aggression from the securitization market as rates have started to come down a little bit. Credit spreads in non-QM securitizations have started to come down a little bit, and frankly, mortgage lenders are trying to keep volumes up, and so DSCR has been a kind of a bright spot of it's really new market share, right, for the non-QM market. The bank, 5 years ago, banks really owned this business. And I think the DSCR market has taken a lot of market share away from the local lenders and credit unions, because the rates became much more competitive. And as the banks got hurt 6 months ago, market share has come towards DSCR lenders. As the mortgage broker market has gotten educated on non-QM products, including DSCR, the distribution mechanism for DSCR loans has become much broader, right? Even 2 years ago, it was really a product mostly originated by private lenders. But as the broker community, the residential consumer mortgage broker community has gotten educated and been looking for volume, they have also now brought in a lot of product, originated a lot of loans. And so
feels like we get calls from brokers every day.
Yeah, absolutely. And so they're only selling to that securitization bid, right? Like they don't have the benefit of being able to work directly with insurance companies like we do, for example. So the rates tend to be a little bit higher for the broker community. But, if you're looking for a solution and, you call your guy who did your house, right? Who did your house mortgage at 3% 2 years ago.
Right.
And he tells you that that the DSCR rate's a 9%. You believe him, right? Because he got you 3. So he's just, he's the one who's in touch with the market.
He must be my low cost provider.
Yeah, exactly. So a lot of product gets originated that way. Because
I just have to stop you right there, Jack, and just say it is not 9% for those of you who might be looking for a DSCR loan. You could do much better.
Yeah, it's been great. We've now tipped into the 7s for the first time in months, which is, I don't know, it feels good.
I've been writing many loans in that 7 and a few 8s to 7.5.
Yeah, I'm nervous to. I feel like I want to just do some refis right now because I'm nervous that it's going to go back up, but we'll see. Anyway, back to the panel. So we were talking about just how that market has evolved, right? And there's a lot more requests with these higher interest rates that we've experienced the past 3-4 months. There's a lot more requests for low DSCR, like sub 1.0 DSCR, or even as low as 0.75 DSCR loans, because with higher interest rates, it's tougher to pencil. And I think investors are having harder access to get liquidity. And so the DSCR loan is an easier loan to get to the table quickly. We can close that in like 3 weeks, 30 days. And so it's an easy button, so to speak, if you've got equity in your real estate for liquidity. And so we've seen an uptick, I think, over the past 60 days in those lower DSCR requests. and what that means, right? So we had a conversation about what that means. Is that a good thing? Is that a canary in the coal mine for distress, frankly? Is DSCR originated over the past 60, 90 days the new subprime investor, loans? And we're going to see all this stuff back at the courthouse 3-4 years from now. So we talked about all those kind of issues.
Well, can I slow you down there a little bit? Because
yeah, sure.
It feels like, look, if we were talking a few years ago, it was the ratio of 1 to 1.25. And I don't think that anyone was ever going to break out of that box. That felt
the sweet
comfortable.
spot is still 1.2 plus. Like, in the insurance companies still want the 1.2 plus. If you want that good pricing, you need to be in the 1.2 plus range.
What's all the talk though of like, we've got some buyers who might be willing to go less, like it feels to me like because of the economics of the deal. Let's see about like maybe doing a sub 1. I don't think we would have been having that conversation a few years ago.
No, we wouldn't have. We couldn't have. The lenders have gotten more aggressive, frankly. I was looking at this. I was nerding out a couple weeks ago. There's this company called DV01, if you can imagine. If there's a company called DV01, and they look at all the remittance reports, which is the reports that the securitization trustees publish that shows the performance of each securitization. And you can get your hand on these reports. And
which is essentially like an aggregation of the loans. Is that right?
Yeah. Okay. So you can see all the loan performance on a securitization by securitization basis. And then they split it apart based off of the attributes of those loans and try to tell you as a securitization investor, that geography matters in this category, and FICO matters in this category, and LTV matters in this category. And like, here's the relative weights of each of those factors, so that you can kind of, right, like the idea is to make better pricing models, right? So that you can price risk more appropriately. And so they really nerd out on the quantitative side on these remittance reports. And when you break apart the non-QM securitizations and you look, we have seen an uptick over the past 60, 90 days in non-QM securitization delinquency rates. Very, very small, a small uptick, but like a small but noticeable uptick.
Sure.
But when you break it apart by type, whether that's a bank statement loan or DSCR or the other kinds of non-QM, loans, DSCR is the best performing of the non-QM loans. And so as product offerings have gotten a little bit more aggressive over the past couple of years, one of the reasons they have is because DSCR performance has been so strong, and it remains the strongest of the non-QM category. And so lenders feel that they're getting paid well for the very low risk that they're taking. And so they've expanded the box a little bit. So the 1.2 lender, some of the 1.2 securitization lenders went to 1.0, and then those guys said, hey, everything still looks good. Let's drop it to 0.9. Let's drop it to 0.75. And put some LTV overlays on it a little bit, but to mitigate their risk. But they're creepily, they're creeping and getting a little bit more aggressive. And who knows? We'll see, right? Only time will tell when they've gone too far. But certainly, right, that's human nature. They will go too far and be a little bit too aggressive at some point. But hopefully, we don't kill the golden goose here and originate a bunch of crap loans, and then pricing goes up for everybody. So that's what the industry wants to avoid.
Is this a category, Jack, where you can only have so much diversification in what a DSCR loan can be, or do we find new products coming along? Like, are there any note buyers out there who are writing guidelines that feel like, oh, that's sort of a new product?
I think on the DSCR side, because all of those most of those end up in securitization, there's relative conformity. Because the thing is with the DSCR loans, the loan buyer wants to put those into a securitization, and they want to get that securitization rated, because once they get that securitization rated, they get better pricing execution. And so if they write a bunch of like new creative stuff, the securitization the rating agencies. The rating agencies will not give them the rating on those loans, or say like, hey, these need to be excluded for if you want a rating from us. So the rating agencies tend to be like the guardrails around new product development, at least in the rated securitization space, or rated, for rated products, which, the DSCR, that's where you get your best secondary market execution.
Mm-hmm.
Private lenders, though, have certainly been doing that. There was a panel after mine that talked about more like the commercial loan structures, like non-recourse portfolio loans, like the $10 million non-recourse, you're buying build to rent properties, or you're doing a refinance of your 1,000-unit portfolio in Columbus, and you don't want to sign personally. And so you can get a loan from a more commercial style lender. And those folks have become more creative in their structures to accommodate the higher interest rate environment.
Mm-hmm.
In terms of incorporating interest rate caps to help make the DSCRs work on those loans, because they tend to be non-recourse, so they can't write a 1.0 DSCR. Like, it must be at least 1.2, because they get tossed the keys if the deal doesn't work out.
Right.
And like with some like a little bit longer term, like 2 or 3 year bridge loan structures, we've seen that kind of creativity in those balance sheet lenders, particularly in like the larger size balance sheet lenders. That's where we're seeing kind of the I would say that that's the front edge of product development right
Interesting.
now.
I was thinking more along the lines of like, calls that we get here from folks that we might not be able to help. Like, I've got a 12-unit deal. I've got stuff that just doesn't fit the box, and I'm wondering if there's any talk amongst like, how do we capture that business too? Because there's a lot of that. I mean, there's just a ton of that stuff.
Yeah, the multi, like the small multifamily is a relatively undersupply or underserved market, I'd say, because it's this in between where it doesn't fit into the rating agencies' models of a DSCR loan, so they don't want to. So you don't get very good pricing. So you don't get the best pricing because of the rated securitizations. But then but you can also go Freddie Mac multifamily loan, right? But no one really wants to work on a $600,000, like Freddie Mac. Freddie Mac's originators don't really want to work on a $600,000 loan. So you get stuck in this no man's land where if someone's willing to do that, they're going to charge you for it, right? Like you get higher pricing for it. And yeah, that's an issue, right? Like it should translate to lower asset values, right? In that middle ground, right? In that 12, or call it 11 to 30 units are tougher to finance because they just don't fit in anyone's they're no one's fastball. And so you'll find and banks, frankly, are like the ones who they're the balance sheets that have financed those. And view it as, hey, I get to charge an extra 50, 75 basis points. And it's really that, it should be a DSCR loan, or it should be a Freddie Mac multifamily loan, but it doesn't really fit in either bucket. So I get to charge you an extra 75 points, and the bank feels good, right, about doing that. So that area of the business has been really kind of like left behind a little bit as banks have become more reluctant to lend on commercial real estate, including residential multifamily. And so I do think that middle ground there is they're the ones that are like on a relative basis still the most underserved.
Do you see that as an opportunity
I see it as an opportunity for banks to write some really high quality CRE paper. But they're the only, frankly, they're the only ones with the balance sheets and the cost of capital to be able to serve that market right now. Like your private lender market, like, yeah, I'll do it for you, right? I'll do it for you at 12%, but like no one wants to hear that, right? They want an 8% loan because that's the appropriate pricing, frankly, right? Like that's what it should cost, given that risk. But the banks are the only ones who really still have a cost of capital and a small enough, and frankly, a distribution network, right? They're loan officers. They have loan officers who can do a $700,000 loan profitably.
It's a very local business, though.
Yeah, exactly.
You're not taking deals from all over the country there.
Yeah. you could see someone coming in and being like, hey, I'm going to go take this, right? Like it's a list that you can pull off the public record, but it's the kind of thing where you'd go raise $500 million of equity and say, I'm putting together a program and we're going to go do a securitization. I'm going to do enough of this that we're going to do our own securitization of this product. And no one's, I don't, to my knowledge, please, if someone knows about a lender that I don't know about, who this is their fastball, this kind of like, 10 to 30 unit multifamily, hit us up in the comments and shoot me an email. But I don't know of anybody who's really stepped up to try to own that space.
We'll look forward to the Jack Bevere business plan on that space by episode 25.
Hey, yeah, speaking of which, we're raising a new fund. It's about 10 to 30 unit multifamily.
Newsflash.
If anybody wants to invest in our new fund, we just decided to do it 3 seconds ago. It's going to be a great opportunity. It's a very underserved market. I just gave you my whole thesis.
And it was all facts. So any other takeaways? And then I want to shift to one last thing. It might be a little bit of a curveball for you if you knew nothing about it. But any other takeaways from the panel? DSCR panel?
Yeah, I mean, a point that I made that I thought landed well was because the DSCR market is still, there's maybe like 10, maybe 15 loan buyers, and each of them have their own opinions of underwriting guidelines.
Oh, they do.
Everyone's different. There's very little conformity there. And at different points in time, they are more or less aggressive than each other, and it moves, right? Like depending on the news or depending how the head of investment committee felt the week before, the pricing for each of those loan buyers moves over time, as do their guidelines. And so if a borrower is working with a particular originator and that originator is tied to one source of capital, you're only getting a look at one of those 15 programs, one of those 10 programs.
Can I break that down a little bit?
Yeah, sure.
So if we get a call from an investor who wants to do, I got 15 units, I want to put it all into one loan, DSCR loan. We have access to how many note buyers, Jack?
10. We have 10 MLPAs in place, yeah.
So 10 folks that we can throw that loan out to. And chances are that we know, before we get the loan, which one's probably going to be the best, which one or two will be the best fit. However, what Jack is saying is that there are originators out there who have access to only one note buyer.
Yeah, one or two of those, yeah.
And if the guidelines for that note buyer are rigid, that's a box that you're either going to fit or you're not. And so I think what you're saying is that go ahead and finish the point. So
yes, exactly. So like if you go to your guy and he's got access to one program and you're slightly outside of that guy's fastball, well, you're going to get charged a bunch more for the fact that you're a 1.18 DSCR, right? Or whatever the case is, or your FICO is 715 instead of 725. And so the way we've set it up is that we work with basically the entire market. And so when a borrower comes to us and gives us their scenario, we plug that into basically a huge Excel spreadsheet, which aggregates all of the guidelines and all of the pricing for all 10 of those loan buyers and spits out, hey, at 75% LTV, you should go with this program. At 70% LTV, you should go with this program, and here's pricing. At 65% LTV, you should go with this program, and here's pricing. So we give borrowers, it's basically a best execution model of figuring out where that situation for that particular property fits best to give the borrower the best pricing. And it may be the case that you come to us with 4 properties and we put you into 3 different programs because it's going to save you a quarter point on the rate for 30 years to split it apart. And it, even with some additional closing costs, it actually that makes good sense. And that's what our loan officers do. They counsel folks on like, hey, we should split this up, go to, 2 with this program, 1 with this other guy, and then go get you the best execution on that. And so if you're not, so that's like a really important thing to do in such a heterogeneous market, right? In such a heterogeneous product, it's important to get a survey of the entire market, which in the past, if you were going to, or not in the past, but if you're going to, which is kind of serves the function of a mortgage broker,
Yeah.
but who may hopefully is working with multiple buyers, but the mortgage brokers don't have access to the insurance company market because they're not selling the loan, they're placing it to somebody. So they only get access to the securitization products, the secondary mortgage market products. They don't get access to the balance sheet lenders, the insurance companies that are keeping this stuff on balance sheet. And so we're kind of like, right, like, so we're kind of like the best of both worlds in that when you can get a best execution quote from us, you know that you're getting the best that the entire market has to offer at that given point in time for your given scenario. And since we're selling directly, you don't have to pay for a middleman either. And so that's been our value proposition. That's why we do DSCR. Our core business has always been fix and flip. We added DSCR because there was so much overlap between those two products. But we built our DSCR program to be that best execution model so that we knew that we were always promising the best that the market had to offer at any point in time.
Yeah, and the only way that you can do that is by having that breadth of buyers who,
right.
Yeah, it would be impossible to be a top-notch originator if you didn't have access to all of the buyers in the market for the DSCR product.
Yeah, exactly.
Yeah. So last thing in the time that we have left, and we'll just take a couple minutes with this, so I don't want to blow your mind here, but Fred sat on a Shark Tank.
How'd it go? I didn't get to see it.
Oh, you missed something. Honestly, it was really interesting. They had two different scenarios. Did you happen to see the case studies by any chance? Oh,
no.
I asked Fred, I guess he may have been on the plane when I shot him a text, but so they basically came out with two scenarios. There were two guys there who had portfolios, Jack, that they wanted to sell. And the one that stuck out to me that I found interesting was 255 properties, single-family properties in South Bend, Indiana. Fairly close to Notre Dame. However, you wouldn't call this a student rental portfolio. Like a couple of them may have fallen into that category, Jack, but not all of them. So it was $29 million asking price for 255 single family residences. I'm just going to give you like the things that I remember of this.
Mm-hmm.
They were all, the average build was 1940.
85 grand a unit, roughly. Okay.
He's already doing the math.
I know where this is going.
So the company who owned the portfolio had put in about 1.5 million in capex, and what I got out of it was mostly roofs. A lot of the properties had new roofs, and maybe a little bit of turnover. The place turned over, and we put on some countertops, and I didn't get the sense that there was any full gut rehabs in these things. Though, if you listen to this guy, these places were all bulletproof, right? The question was, he was obviously looking to sell it, outright. And I think, I don't know the numbers. I think it was like a 7 cap that I guess they were projecting on the,
mm-hmm.
For that sale price. And so the question
was the average rent?
$1,200.
Oh, okay.
Something like,
okay.
Yeah, something like that. I was maybe 1,000. I know you're going to ask me all the questions that the Sharks asked that I didn't take notes on, but so Fred was kind of sat back and listened, and the guy who they were dubbing Mr. Wonderful, sitting right next to Fred, gave the following offer, and he was very fast. I mean, jumped right in with an offer. And the offer was, okay, we're not going to buy this thing outright, but we'll become a 50-50 partner with you on it.
Mm-hmm.
And I don't remember the terms of the deal, but if in a scenario like that, I was really shocked to see the guy step up so quickly and say, yeah, we'll do 50-50. We'll give you this loan. We'll hold the properties for another 5 years. We'll peel off the ones that are crap right now and maybe do a little revenue monetization, as you like to say. And so that was one of the offers that came across. And I think Fred sort of had this look on his face like, no, I wouldn't do that. And so can you think of any scenario where that might be an interesting offer to jump in bed with this 255 properties?
I mean, I think that I get where the guy's coming from, right? Like, because the operator is such in that price point, right? $85,000 house built in 1940s, $1,200 rents. Like, that's like an operationally intensive business.
Yes.
And so, like, you get tired after a while, and managing the expense ratio is like the entire ball game. Uh, and your tenancy duration,
Tough.
your tenancy duration is like, the X factor, right? Like, do you have 2 to 3 year tenancy duration, or do you have 5+ year tenancy duration? And like, if I ask you those questions, I know what the expense ratio is going to be. Like, I know I got a good sense of it.
Right.
So like, it's a good tell, right? It's a good question. It's a good structure to ask the guy, because if he's not interested in staying on the ride with you, well, I think you know everything you need to know about how difficult it is to operate those old houses in that affordable market, because that can be a taxing enterprise. And 300 is just enough to not be able to really afford a full team behind you, where you're still getting like a lot of calls. Like, you're in no man's land, right? Like, once you get 500-600, you can afford a real professionals, you
Top
can like
notch.
real people, right? You can get like real people behind you. At 300, it's like you with some assistance. And like, if that guy is not willing to like go along for the ride, like, you're like, dude, I'm just inheriting your headaches, right? So I feel like
Couple more.
it's the right structure to figure out, to learn a lot about what you can't ask, right? You know what I mean?
So what I thought was interesting about it was I did sense that the guy who was selling the portfolio seemed really knew his stuff, but he did seem a little tired.
Tired.
And a little bit. And these houses were not homogenous, Jack. They were like, there was like a mansion, like we would see up in Roland Park. And then there was like the little Rambler that you'd see over in Essex. And so I think the 50-50 deal was still out there, but the guy was, I don't know if he was being tongue in cheek or if he was actually really serious about it. Fred did come in at the very end with an offer.
What did he say?
I'll paraphrase. He basically came in with the Gordon Gekko Wall Street offer, and it was like, I would take it and sell it all. I would sell it for the price of the parts.
Yeah.
Start with the the crappy ones that you don't want anyway. Get rid of all of those, and then just basically start
make your life better over time. Yeah,
just start peeling them off one by one and sell the whole damn thing.
If there's a spread, right? Like, if these are like 135 ARV or whatever, and you're offering me a great deal here at 85 grand because it's a good cap rate, just get in there and just start selling them off.
Right.
And that's a tough price point, right? Like, 135 houses, that's the price point where you sell it 3 times to an FHA buyer before it sells, before it actually goes to closing. So like, it's a heavy lift, even doing it that way.
I will say this:
there is a spread.
To sit in on that panel, for me, you learn something. You should learn something in every panel that you sit in on. When a guy like, when you're sitting up on a panel with some other folks, there's nothing that you're not going to learn going into something like that as an audience member. But to watch them sort of pick through all of the details of the other portfolio I won't get into, but it was 16 brand new houses that were built in Florida. And so much different, right? It's a very homogenous sort of, there's only 3 separate models. You could sort of break it out. It wasn't a lot of heavy lifting to try to figure out what the portfolio was. That said, it was a 45-minute absolute jam-packed info session that, getting back to why people should attend events like this. Look, if you're a guy and I've got 15 rentals in my portfolio, or I've got 50 rentals in my portfolio, and I'm trying to get to 100, there's no reason why you shouldn't be at something like IMN. And again, we're not making a dime off. In fact, I think you pay handsomely to be a part of IMN. So we're not making any money off of. So yeah, I was just I was blown away by the level of the investor there. I thought that the vendors, there was a lot of really top-notch vendors at IMN. The next one comes up in Miami, right, Jack?
Yeah, Miami in May, I believe.
They're twice a year. I think it's Scottsdale and then Miami. I'd encourage anyone who wants to up their game, who wants to get better operationally, who wants to have access to better capital, just speak with just a better level of investors. I'd really encourage everybody to check it out. In fact,
Yeah,
over the next few episodes, we're going to try to get on some of the attendees. There's a lot of folks who come in each year and they're recognized for, how they've grown their businesses, how they become better, they receive awards. And so we intend to try to get some of those folks on, so you can hear directly from investors who were there as well. But any last takeaways?
Yeah, so we did speaking of which, so we brought all of our recording equipment to the podcast equipment to our room, because we had a room set up there as a sponsor, as a vendor. And we endeavored to grab a whole bunch of people and be like, dude, we'll just do a bunch of 20-minute recordings and get a bunch of content. There's so many great people here. And so we set everything up, and then the conference started, and then for 2.5 days straight, we were just talking to people constantly, and going to different sessions and talking to tons of people in the hall. So we didn't execute as well on that business plan as we could have. We'll do a better job in Miami of getting more on-site recordings, but we were able to grab a really good friend of ours, Alex Hermani from Dallas, who's 99 Capital, and he was nice enough to give us about 20 minutes right before he went to talk on a panel and talk about his new fund and his experience in Dallas. He's got about 300 units there, and he just raised a new kind of friends and family fund, and he's going to start buying rentals again. He's one of those guys who's been sitting on the sidelines the past couple years because he just hasn't seen the economics be that attractive, but he's now dipping his toe back into the water. So that'll be the next episode that's uploaded, our conversation with Alex. So definitely check that out. And all the other dozens and dozens of operators that we talked to, as Craig mentioned, we'll get a bunch of those guys on here, because they've all got great stories, and it's really interesting to get their perspectives on what they're up to these days.
Yeah, I think what we discovered was when you go to this conference or conferences like it, you truly are pulled in a million different directions. And when you try to catch somebody for a drive-by, hey, come sit down for 20 minutes. First of all, it's even hard to find them in such a large place, much less then get them to sit down. So we'll be a little bit more intentional about scheduling in the future. But Alex is a great conversation that I hope everybody checks out. This is a guy who literally started off with one house and has now grown it to 300 plus, and has now built a fund around doing the same. So please check that out. Jack, anything else before we finish up?
No, it's great. It was a great conference, and as Craig mentioned, I recommend anybody come to that as well. It's one that we've gone to. It's the only conference that I always go to. I'll say that. Right? Like I go to the IMN twice a year, and I've been doing it since 2013 when they started. I still get value.
Well, that's it for today, folks. Hope you enjoyed this episode regarding IMN. I'm Craig Fuhr, and this is Jack Bevere. Thanks for tuning in to Real Investor Radio. We'll see you next time.